My name is Gerard Minack. I'm on the board of Morphic Asset Management, and I'm here to give you some thoughts on the outlook for the world over the next 12 to 18 months. I should say these are my thoughts, and the team at Morphic can at times disagree with me. So what can we say about the next 12 months? Well, the first thing is the world's going to start 2018 with the best head of steam we've seen for probably 6 or 7 years. Global growth in 2017 has been shaping up as the best year for global growth since 2010. Although if you look at my first slide, which shows global trade volumes and also corporate sentiment globally as measured by the so-called PMI or Purchasing Managers Index, yes, they're both at the strongest or highest level since 2010, but it's a fairly low hurdle. The world has been through 4 or 5 fairly mediocre growth years, so to say it's the best for 5 years is nice, but not as strong as what we saw through the last cycle. Nonetheless, better growth is feeding through to earnings. So my second point is corporate profits are up, and we've had a cracking year for global equities in 2017. My view is that we'll be able to maintain that momentum at least into the early part of 2018. It is worth noting, however, that what were expensive markets at the start of the year have got more expensive through the course of 2017. My second slide shows a global equity index, the MSCI All Country Index, and earnings for that index. And as you can see, both of them have curled higher this year, but as you can also see, since the lows of late 2016, global equities are up over 40% at a time when earnings are up less than 20%. So yes, earnings have been supportive for equities this year, but the gains in the market have far outpaced those earnings. So as a result, we've seen expensive markets get more expensive. So far we've got a good global head of steam going to next year. We've got earnings responding. We've got markets getting more expensive. The third point I'd make about the outlook is I think we continue to see a reversal of one of the big trends that we'd seen since the GFC. The big trend we'd seen since the GFC in global equities was the outperformance of US markets versus other markets. Now my next slide just compares earnings in those two markets, the US and the rest of the world, and you can see this is an obvious reason why the US has been outperforming. US earnings have made new highs perpetually through this cycle since about 2011, whereas earnings outside the US continued to fall up until early 2016. From that starting point, as global growth has improved, there's been much more earnings upside potential outside the US. So what we're finally seeing is non-US markets outperforming the US market if you look at the performance in common currency terms, which is how most people tend to measure them. And my view is, while ever the global expansion remains fairly healthy, US will continue to underperform global equities. I'd also have to say, though, that Aussie equities will probably underperform all the global equities. So the pecking order really is non-US markets, the US market, then the Aussie market. The final point is, are there any clouds on the horizon? Well, there are risks, obviously. Some of them are, in a sense, hard to measure. I have no particular edge on what's going on in places like North Korea or the Middle East. And the way markets typically treat these political issues is they ignore them until it's the only thing that matters. I don't know if we're going to get to that point on those two particular issues over the next 12 months. In terms of the risks that we can say something sensible about, the most obvious is, in a sense, the usual suspect, a policymaker error. Now, in that sense, the main focus should be on the US, where their central bank, the Federal Reserve, is far further progressed in tightening monetary policy than central banks elsewhere in the world. Now, I don't think the Fed will make a mistake in 2018, but I think there's a risk that it'll make a mistake in 2019, and that may be something that starts to weigh on markets in the back half of next year. The key to the risk is simply that the Fed tightens monetary policy too far, and this all revolves around an issue of what's tight money policy. Now, many people, myself included, think that rates don't need to go very high in this cycle to start to impact growth. My own view, for what it's worth, is that anything in the US over 2.5% to 3% on their policy rate becomes an issue for growth. Now, if you look at my final slide, which shows the outlook for interest rates, you'll see some square dots there. Now these are the Fed's own forecasts for their interest rate. And what they're telling us is that they think they will push their interest rate towards 3% some stage in 2019 and 20. In other words, if the Fed delivers on its forecasts, I think that could become a real issue for financial markets in the second half of next year. So in summary, global growth looks good, corporate earnings are responding, while the expansion looks healthy. I think US equities underperform. I think there are better opportunities in emerging markets in Europe. And finally, if you're very far-sighted, you can see some clouds on the horizon emanating from monetary policy makers, and that could be the big story this time next year. Anyway, thanks for listening. I hope you have a good day with the Morphic team. Cheers.